All right, so our next part is trading with confluences. The main goal is for us to stack reasons for entries. So we need to understand that when we're looking to take a trade, we want multiple reasons for why we're taking that trade, right? Something I like to say is that when you take a trade just based off of one confluence, you have a 50% win rate. But when you take a trade with stacked confluences, it increases your win rate by an undetermined amount. Okay. And I know what you're saying, undetermined. Yeah, because there's no way to actually determine it, but just know it's above 50, right? So think about it. What does it take to be profitable? You really just need anything above 50%, right? Because now over time, you're going to be profitable because you have that extra 1%, 5%, 10%, right? You're above 50%, so you're profitable. Okay. Let's start looking at that, right? So our main confluences, the ones that I'm going to teach you today, it's going to be liquidity sweeps, high time frame bias, market structure, fair value gaps and inverse fair value gaps, session timing, order blocks, break of structure, some equilibrium, and reactions from key levels. Okay, so these are the confluences, and these are just multiple reasons to support one trade. That's why that matters. So, explaining why confluences matter is very, very simple. Okay, it literally matters because it gives you higher probabilities, like I said, within it increasing your profitability and your win rate by an undetermined amount, as well as cleaner setups, and you have more confidence. So, knowing that, hey, for example, we're sweeping liquidity, we're in a high time frame gap, right? We're shifting market structure in the up direction. It's going to give you more reasons to actually take that trade. It's going to take away that fear factor. It's going to give you more confidence when it comes to taking that trade, right? Okay. So, confirmations, right? So it's also confirming your direction. So let's say you have a bias, right? You sweep liquidity. Now you have your bias, and then you're in a high time frame gap as well, right? Or it's also the right time of session where price is supposed to be distributing, right? Or you have a break of structure. All these things are going to give you more and more reasons, as well as strengthen the trade overall, because there's going to be multiple confirmations aligned in one place. Okay. So let's give an example. So we have this trade from today. Where's this at? I had a trade from today. Okay. Let's drop down to the 1 minute. So this was my trade for today. I took a trade based off of this fair value gap right here. Okay. So I had a trade off of this fair value gap. Now, with it just being a bullish fair value gap, this is a single confluence, right? So it's like, okay, this trade worked out, but right now this trade only has a 50% win rate, all because we don't know other reasons for why this trade worked out. This is just from what we're looking at. But obviously there's more confluences, right? So some other confluences that I had during this trade was SMTs at these lows right here. And then on ES, our sister pair, our correlating pair, we took this high, we broke this high, right? Obviously, we didn't break it right here, but let's go ahead and show you ES. So here comes ES. And as you can see, that's that same high. We take that high. It's that same fair value gap that also existed on NQ. And this is called correlation as well. It's also another confluence, right? So we're correlating between ES and NQ. We're taking highs on NQ. We're breaking structure. We're putting in the same type of gaps that we're seeing on NQ. We're seeing that on ES as well. And then what does NQ actually do? We tap into that gap, right? So we tap into that gap. We have SMTs at the low, and we're able to deliver to the upside, okay, for 1 to 1.5. That's my risk to reward, okay? So just like that, we're able to stack these confluences to take this successful trade, right? Let me go ahead and just pull this up for you. So we have kind of proof of the trade because I did record it this morning. So I was already inside of the trade. Okay, so I was already sadly inside the trade. It's like when I started recording, but as we can see, this is the same area, right? So as you can see, right? Let's get that back up. Right here. We hadn't taken this high on NQ, right? So like I said, I just clicked it a little too late, but let's watch this trade play out. So as we can see, price is pushing up, right? And Just like that, I had the confidence to hold the trade, to take the trade in the first place because all of these confluences were stacking on top of each other. And when it comes to trading, I had to wait for this trade to even take place in the first place, right? I wasn't able to put my take profit on there, so I did do a manual close. But except for that, as you can see, we were able to execute, and it's all because we were able to stack our confluences and give ourselves enough confidence to take this trade in the first place. Okay. Okay. And then other things, right? These are things that actually do also affect trading confluence wise, and that is going to be your bias, right? Your liquidity, having your entry model. This is all things that build a trade, right? So having a bias, which we do have here, and I'll also show you that when we get to it. We're going to use this trade as an example to just build out an ideal trade. But you have a bias, you have liquidity, you have an entry model, and then you have a target, right? All of that exists within this trade, and we'll just break it down as this videos continue. But one good trade is greater than 10 random trades. We got to remember that at all times. We are looking for quality. I had to wait for this trade to take place, right? So look, this is the New York session open at 9:30 New York session time, right? So from right here all the way to right here, we were waiting. We were seeing all this. We are not FOMOing into price pushing up. We're not worried about any of that, right? We're waiting for our ideal chance to take a trade. And as you can see, we also do not care of the after effects, right? We take our 1 to 1.5 and we're done. But look at how far this trade runs, right? We're not here for this. We're here for the low hanging fruit. We're here to take our win and carry on with the rest of our day. Because now, imagine you're taking this trade, you're still in this trade. An hour goes by, trade starts to pull down. Now you're thinking this, thinking that, whatever, right? So some people are okay with that, but this is what is going to keep you on the right track when it comes to trading. It's just being able to not FOMO. We're not worried about the rest of that, right? We've taken our piece of the pie and we're done for the day. Okay. Um, yeah, so with that being said, we're going to jump into our next lesson, which is going to be liquidity, understanding how we were even able to find a direction for this trade in the first place, how we were able to know that this trade was even going to probably set up for a buy in the first place, right? Because like I said, we're trading with confluences. There's multiple reasons for why we take a trade in the first place, and having a clear direction is one of them. So let's jump into the next class about liquidity.